Hey guys, Mike out here with Steve Zolinardo. We're here doing another episode of Real Estate on Record. Today we're going to talk about the new mortgage changes that we're seeing coming out at the end of this year, December 15th. We're supposed to get three major mortgage changes, which are going to obviously help our affordability, some competition in the mortgage market, obviously. Um, I guess I'll start with the first one. The first one's going to be the 30-year amortization change, basically for new construction builds and first-time home buyers. Currently, they can only get an amortization of 25 years, but as of December 15th, government's pushing that to 30 years. And like you said earlier, I think this was previous. I think we looked it up. It was like 2012.
They had this prior,
Yeah,
yeah,
yeah.
yeah, yeah.
We got up to 40-year amortization at one point.
Oh
I'm
wow,
pretty
I didn't
sure.
even realize that.
Yeah, and then they cut it back.
When did they
right?
switch it in 2017?
I think it was 2012.
They pulled off the 30.
They changed it back from like 2000. I think after like 2007, 2008 is when they bumped it up
Yeah,
to make things more affordable. Like '07 to '09 was a disaster a little bit, right?
yeah,
Not so much here, but more in the States, but we still needed some stimulus here. So I think that's when they gave us up to 40 years to obviously make monthly payments a little bit more affordable.
yeah,
And then 2012 is when they retracted it back.
yeah. I mean, they're going in the right direction with all this stuff. Obviously, the economy is suffering right now. It's new construction right now. It's builders doesn't make sense to kind of get off the ground and get going. Land costs, what they cost them to originally buy the land. I mean, mind you, some of these guys have been hoarding land for
There've been
20.
land banking.
Yeah, but again, they're not looking at it when they bought it. They're
No.
looking at its current value today, and then ultimately, is it going to be profitable? Because whatever they've done, I mean, they've held it for 20 years. And can you imagine 20, 30 years? So I think that they're going in the right direction, but it's just by the time these builders get off the ground and start building again, it's going to be a little bit of time, right?
Well, going back to it, I think it's going to be like come back to rates. Rates have to drop for, I think, builders or just like the construction industry, let's say, to move forward with projects to keep people employed. People employed will ultimately be our buyers that are going to move into these new houses. So I think it's going to come down to our job numbers, because at the end of the day, if we're not secure that we have a stable job to go to, we're probably not going to make a move, right? And we all know that most of our economy in Ontario is running on immigration and construction, right? So
Yeah.
if we don't have that buyer's confidence, it's gonna hurt us in the long run for sure.
100%. I think, yeah. I mean, it's like a vicious circle. So the good thing is, if there's no new construction being built, that means resale will get taken up. So
Mhm.
kind of like a direct correlation to the resale market. But we know a resale market right now is at the highest amount of inventory I've ever experienced. Right now, we're at
That's
20.
why I think it's a great opportunity. To be honest.
100%.
Yeah.
Yeah. Well, I mean, we'll talk about our client that just bought now,
Yeah.
just recently. But yeah, I think it's definitely going to be a good opportunity because people are kind of on the ends. If you can afford it, you have the money and the means to do it. Why not? Right? It makes total sense.
And the stability in your job. Yeah.
Yeah, for sure.
This is the time to take action and
Yeah.
take,
Did you
not
want
take advantage, but
tell us about the story now?
yeah.
With our
So
client.
one of our
Yeah.
clients, we bought 4 acres in let's call it Springwater, and we sold the property there last year for 1.6 million on 2 acres, right on 1.6 even. And okay, that house was a different house, bigger house, let's say. But if we broke it, when I reverse engineered it and broke it down to like excluding the value of the house and just breaking it down per acre value, we've just purchased 4 acres with a 1,300 square foot house, a barn, a generator, new roof. It needs some, don't get me wrong, it needs a little
TLC.
yeah,
Yeah.
TLC here and there for sure. But we basically bought it for land value with all these things. So our clients are going to come in here, tweak what they have to tweak. But at the end of the day, it's a solid purchase because you got all this plus the land plus the house, right?
Yeah.
So that's what we're saying about opportunity right now, and we jumped on it. It was good value right away. We bought it within a day on the market, right? They don't come up often.
And you know, like, even because I remember you called me on the Friday when you guys the negotiation started, and it was like the 72-hour irrevocable. So when someone puts a 72-hour irrevocable, this had an issue obviously with the power of attorney. So it's usually going to take a few days extra to kind of get everything through the lawyer and have him review. But at the same time, this was they do this up purposely for a bidding war. So what they do is that they'll price it a little bit lower or at market value, and then ultimately they'll have a 72-year revocable period, which is basically 3 days that they can accept other offers, and other offers can be sent in at the same time as yours. And then ultimately they'll look at them. And then did they not get a second offer during that
They
period?
did get a second
Yeah.
offer. Yeah.
Yeah. So and then you had to go up a little bit, but again, what we paid is way
It
below
was
market.
marginal.
Yeah.
Yeah. I think we're below land value, to be honest.
It's
Price
crazy.
per acre.
And,
So,
you know, even
nice lot too. Level lot. Beautiful lot.
it's there. I've known Mark for a while. And that's like his dream is always wanting to have some acreage, stuff like that. He's
Yeah.
like, he likes that, the dogs and stuff like that, and
Perfect,
fishing, hunting. But so even his journey, we bought him a property in Bradford originally, corner lot. It was a nice house, clearly, but not what his dream is. You know what I'm saying? So it was like we've
Stepping
created
stone.
a stepping stone. It was smart. We created into like a duplex. So we had a renter in the basement, and then he would live on top. And then when he moved out, we had a duplex, and then ultimately sold that, made decent profit even with the market that we're currently in, and then used that to literally, I think that he actually, if he sold the other one for 880, this is what, 800K.
770.
Well,
Yeah,
there
we
you go.
sold for 880 and bought
Yeah.
for 770.
So there you go. Like he sold it. We sold his property. What was it, last year, I think?
Earlier this year.
Oh, okay, so there you go. He tapped one into the other, and you got a way better property and something that he dreamed about, right?
Exactly.
Yeah, so it's good. Yeah, as long as it's just something like that, you can take advantage of the market. And then, like 3-5 years down the road, when things are just insane again, that property is worth $1.5 million, $2 million, depending what they do to it. You'll never be able to buy that again.
No.
This is like these are like, you got to be smart now. If you're able to kind of like groove your kind of future, this is a good time to do it. Like chart it. Yeah, like Mark did.
Yeah.
Good job, Mark.
Talking to like savvy investors that we know, like they're still looking to make moves right now, right? I think it's the herd right now that's kind of like sitting on the sidelines. You kind of want to go against the grain too.
Well, I don't blame them either.
If you can.
It's just almost being abused too with the way everything happened, because everyone under the sun believed that no one was going to, like, the government's not going to raise the policy rate. They can't do it. All the mortgage agents, all the financial consultants, all the economists were all saying that they can't, the government's never going to, go really hard in the paint on these interest rate hikes, the policy rate hikes. And then it went. And then people were left in shock because they didn't believe it. So now, sure, they're on the sidelines. They don't trust the system right now. They're going to try to rebuild their trust in what's currently happening. And then some people will come out of the box, a lot quicker, like Mark did. Then some will just need some, finagling and kind of reviewing it, some more time to think about it. Like we have a stack of business going forward, and it's, they're on the sidelines. It's like, if the perfect thing came up, and even at that point, if they're not pre-qualified, they're not talking with a mortgage or a lender, it's going to be hard to come out of the box quick. Yeah. So you're almost gonna, if you are thinking of considering to be in the market next 6 to 12 months, talk to your lender, like get that all organized. It doesn't cost you any money, just a little bit of time. Obviously, you got to give your NOAs and all that stuff, your stubs, to make sure everything, so you can qualify. But at least you have that relationship already started with whoever you're dealing with. And then when you're ready to go buy, you already have, like 30% of the work already completed prior. And then you can start negotiating deals, and then with confidence, most importantly. Yeah.
And if you don't have someone, obviously reach out to us, because we have a great crew of mortgage brokers that can put you into that position. So we're qualified and ready and able to buy when that right property comes. And the thing is now, like we're talking about the right property, like we're sitting at the highest amount of inventory we've ever seen.
Yeah.
So if we can't find that property now, and jump on it,
It's true.
You're probably gonna have a lot harder time when the rates come down, or when rates come down, because then everyone's gonna have more buying power, right? Right now we're at 26,000 units. We started this year, to put into perspective, with 11,700. So we've more than doubled our inventory. So
Wow. Yeah.
when that happens, like when that inventory goes away, we're gonna have multiple people trying to buy those properties, right? And we're still seeing the good stuff go. Like,
Yeah.
if it's a nicely renovated place, or it's superior to most of the other houses that were offered in that area, it's still going. If the value's there, they're moving quickly. It's the ones that are kind of like, you need some work and some love, and people don't want to do that right now, to be honest, because construction costs are expensive. So those are sitting, but
So it's also at their price.
yeah,
If they're still need work on their property, they're still priced aggressively. Like it's not gonna it doesn't make soup anymore. It
yeah.
doesn't before you're able to kind of throw that out there and still maximize in the market, but it's not it.
If you could get it for a cheaper price.
100%. My real estate coaching, like Mike Ferry was like old school American hardcore, like hammer on the table kind of guy. And it's like during these times, it's like you got to be price aggressive. You got to have more features and benefits than the next guy, and you got to be priced better than them. That's what gets you out of the gate if you got to sell your property. And the reality is, if you're getting out of the gate and you're selling, like again, and these are not sales that are happening like overnight. Some properties do, but they'll get 2 or 3 offers because they are priced too low. But if you're priced, accordingly to market, and you leave a little bit of fluff, but you're also got a much better product going to the market, like you got to be strategic now. It's a real word. You got to be strategic when you're pricing. You got to make sure that you're looking at everything. You're looking at your lot size, linear front footage, your rear depth. You got to make sure, are we better than the next guy? How many garages do we have than him? So we can price it. You kind of like, again, you think you're undercutting yourself by pricing, accordingly to market. You're not. You're just being smart about it.
And we're talking from experience.
Yeah.
Not that we're telling clients just to do this, but we're doing this ourselves.
Yeah.
The house that we're building in Florida, we're looking at the competition, and the competition is grossly overpriced, like by $100,000 to $150,000 over market value. And when we're looking at it, it's like, yeah, it looks great that maybe we can compete with them. So you go look at the comps and you see that 100 to 150K. Why are we going to do that to ourselves? We're just going to price for market value, let those guys help us sell, and move forward. So we're not just giving this advice to talk about it to get people to sell. We're doing it ourselves.
100%. And I'll go into that too, because when we're looking at it, because we're like, oh my God, like neighbors at 890, like direct neighbor, 3 doors, 3 building lots down. Very comparable house, and ours has more features and benefits than that house, to be honest. Like I think ours is much superior design. Mike had a huge part in the design and then design and the fit and finish. So the house plays really, really well. We have like backed onto a canal with a seawall. That doesn't have a seawall. No. That's just erosion into the canal with a dock. Again, that's a $30,000 to $40,000 option right there. Anyway, so we have so much more features. We're putting a pool in, but we're going to put a cage. They don't have a cage. So just there alone, let's just say that's like $60,000 in upgrades. Let's just say, and not to mention the house. I think our house plays a lot better than theirs. They're at 890,000. Yeah, and we're at 770. So it's like 120K less, and we still have about 40 to 50K in let's say in
added
features and benefits more than that property. And to be honest, now we've tagged in. I did this actually. The property you were talking about, we sold for 1.6. I think that was in Utopia, the community. We got to have finance options for these buyers. To be honest, if you have an option to kind of give a vendor's take back mortgage, you do it. I've sold most of the properties here out of Toronto during like. Obviously, when everything switched, I gave seller back financing. It made sense, and that's what we're doing now with this property in Cape. I teamed up with a good friend of mine there from Chicago, and he's basically given us construction different routes. It's called a 2-1 buy down. So basically, what we do is we put $15,000 in a bank. Instead of doing a price adjustment, put $15,000 in the bank, and it buys down this rate for 3 years. But usually by the second year, because the rates are coming down clearly on both sides of the border, he's going to be able to utilize this, get like instead of a 6.9% loan, it'll be like a 4.9% in the first year, 5.9 on the second, and 6.9 on the third. But on the second, you kind of cash out. You still have about $6,000 in reserve, because that stays in reserve. It's always the buyer's money. And then he can tack that onto his closing costs of the new mortgage. So it's a win-win. But it's also looking at the neighbors at price at $890. They're not doing anything with available like attractive finance options.